What if I told you that everybody lied about Bitcoin? What we see at the top, that's the Bitcoin price. What we see at the bottom, that's the NASDAQ 100. So technology stocks. The common narrative was that Bitcoin is yet another technology investment. It's just another risk-on investment. But really, Bitcoin does not trade like a technology stock. Yes, it crashed together with tech during COVID. It's also recovered in a similar fashion. It peaked at the same time, then crashed, then recovered. But have a look at what's happening recently. Tech is making new all-time highs, while Bitcoin has fallen by 50%. So what's going on here? This here is a chart you've probably never seen before. This is the Bitcoin price divided by the NASDAQ 100. How is Bitcoin performing relative to technology stocks? Now, isn't this interesting? This is a logarithmic chart. It shows how the bottoms align quite nicely on this curved line, but it also shows us that we are currently very cheap relative to technology stocks. So obviously, Bitcoin does not just trade like another technology stock. Sometimes it outperforms and sometimes during a bear market it underperforms. And it has recently underperformed significantly. Now, this chart does not mean that I think that Bitcoin has already bottomed out. Rather the opposite. I think this bear market will continue, but Bitcoin has already sold off to a degree that it's probably not going to sell off more than technology. Now, here is why I think we have to see further pain. This is the net unrealized profit and loss in Bitcoin. This is a chart we can only plot for Bitcoin because here we've got on-chain metrics. We know at what price did a Bitcoin move the last time. That's data that's not available for traditional finance. But check this out. At the end of a bear market, the average Bitcoin holder was in net unrealized losses. So the average Bitcoin holder bought Bitcoin for a higher price than the current market price. This is not yet true though. The average Bitcoin investor is still, even after the decline, 15% in profit. In the past, we always had to reach maximum pain. The average Bitcoin investor had to be in net unrealized losses and then basically give up on the asset as a whole. But this time, even though it feels like we are already at peak apathy, things aren't as bad as they used to be in prior bear markets. In fact, the average cost basis of the average Bitcoin investor is currently at $53,000. And in the past, at the end of a bear market, we tended to fall below that average cost basis by around 10 to 20%. Every single time. That means there's a very good chance Bitcoin will trade again below $50,000. That's at least what I believe. That's how I personally set myself up. And while I don't have a crystal ball, I do think those patterns have a high likelihood of repeating themselves. Simply because many people look at similar kind of data points, and if enough people agree that the price will continue to go down, then this becomes a self-fulfilling prophecy. Then many people don't want to buy. They only want to buy when the price is low enough. Still, relative to technology stocks, Bitcoin looks rather cheap. But this then in turn implies that technology stocks have to go down as well. And I think that is actually the most realistic scenario. They might correct from here. This is the Shiller PE ratio, the price to earnings ratio for stocks. And whenever we buy a stock, whenever you buy into equity, we are essentially buying the future earnings of the company. The price to earnings ratio matters because what we pay today, the price, that's a cash flow that's exiting. The cash flow we get in the future, the dividends that get paid through the earnings, that's what we acquire for that price. The less we get in future cash flows relative to the cash flows we pay out today, the worse the deal gets. And currently, the Shiller PE ratio is at 42 for the S&P 500. So it takes 42 years of earnings to recoup our initial investment when we buy into equities today. And that's very comparable to what we had at the peak of the dot-com bubble. Subsequently, dot-com burst, then we stabilized, then we got the global financial crisis. And this year, this is when Bitcoin was born. So Bitcoin actually only lived throughout a period of expansion, as in risk-on assets tend to become more expensive. We never really had a real crisis during Bitcoin's lifetime. We never had a Great Depression, we never had an oil crisis, we never had .com or the global financial crisis. It was all just expansion. Yes, we had COVID, but COVID recovered extremely quickly. Now, why make those comparisons in the first place? Why don't we just look at US dollar charts? Why do we look at Bitcoin relative to technology? I think it's very important in investments in general to look at opportunity costs, because cash usually is not the real alternative, at least long term, right? Imagine you earn a lot of money, or imagine you just win the lottery, right? Suddenly you've got 100 million US dollars. You will not keep those 100 million US dollars in just plain cash, because you know that over time the US dollar devalues. Thus, we have to allocate this somewhere. We have to allocate this towards an asset class that at least keeps our purchasing power. Cash is no alternative. We only consider investment A versus investment B. In other words, it's relative valuations. It's just a decision what thing to invest in, not whether or not we will invest at all. Thus, US dollar charts are not useful. It's all about, is it equities? Is it Bitcoin? Is it gold? Is it property? What's currently the best asset class to invest in? And so in that spirit, let's not just look at Bitcoin relative to technology stocks. Let's also look at Bitcoin relative to gold. Now, this was just another popular narrative. Some people said that Bitcoin is another technology stock. Other people said that Bitcoin is gold 2.0, a replacement for gold. Now, Bitcoin and gold always traded very differently. While there were some commonalities between the Bitcoin price development and the tech stock price development, that cannot be said for Bitcoin versus gold, right? Those two charts look very different. Bitcoin at the top, gold at the bottom. But once we look at Bitcoin relative to gold, so BTC priced in gold, this chart looks very similar to the Bitcoin price relative to the NASDAQ 100. So this is Bitcoin relative to gold. It does look like Bitcoin is rather cheap. Now that's again just a comparison. I do think that Bitcoin has more room to fall. I do think we have to get into net unrealized losses. What does it then in turn imply? It implies when Bitcoin is outperforming gold, if Bitcoin returns another 100, maybe even 150% versus gold, that then gold should not be a great performer going forward. And I think that's a realistic scenario. Tech stocks are overvalued, but so is gold. This is gold relative to the US money supply. So now we just use another measure to figure out how is something valued. For stocks, we look at the future earnings. For gold, we can just look at an alternative money, right? Gold is the hardest of the monies, and so fiat currency is just a comparison to that. How many fiat dollars are currently floating? So that's USM2 versus what's currently the price of gold. And that's this chart. It's a very long-term chart. It starts in 1960. The dotted line, that's the average ratio of gold relative to the US money supply. Sometimes gold is expensive, sometimes gold is cheap, but it tends to trade around this equilibrium. There's actually a case to be made that gold should not completely offset the monetary debasement, because there's also gold mining, right? The gold supply also grows by almost 2% per year. But let's work with the optimistic case that gold will completely offset monetary debasement. In that case, the price could very easily fall by another 31%. And then we would just be at the equilibrium. We wouldn't even be at the lower end of any of those trading ranges. In other words, I do think gold will go down from here. I don't have a crystal ball. Again, I'm just presenting data here. And the data points, they all align. BTC relative to gold is cheap. BTC relative to tech stocks is cheap. Stocks in general seem to be expensive historically. Gold in general seems to also be expensive historically. While this does not mean that Bitcoin has to turn around from here, and while I do think we will fall further, I'm just considering alternatives here, right? If you currently find a very good property to buy that has very high rental yield, we can maybe lever this up a lot for very little cost, then that might be the best option. Or if you find certain trading approaches that are completely delta neutral, let's say some arbitrage, interest rate arbitrage, that's currently what I do, or let's say relative valuation plays, right, where we bet on falling altcoins, where we've got some source of income that's completely independent of valuations, that's maybe also a good allocation of capital. What I don't think is a good allocation of capital is to now have a mix of tech stocks and gold. And if that's currently your allocation and you've got 0 Bitcoin, you don't have any exposure to property either, and you don't have any trading strategies that might be independent of those valuations of tech stocks and gold, then maybe it makes sense to reconsider. At least, again, given the data. I hope you found this interesting. If it's your very first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time. Cheers.